Asian shares struggled before China data that is likely to amplify the case for serious stimulus, even as Beijing seems deaf to the calls, while rising treasury yields lifted the dollar to a 2023 peak on the embattled yen. Meanwhile, Chinese blue chips lost 1.1% on top of a 3.4% decline last week amid a string of disappointing economic news, culminating in a dire report on a new bank loans in July. To give us some perspective when it comes to the markets, we are joined by Ricardo Smith, who's the Chief Investment Officer at ABSA Investments. Ricardo, thank you so much for your time. I mean, what's your sense of market sentiment right now as you look at what's unfolding, looking at how the Chinese markets performed, and also some of the muted sense of things coming through from our local side?
Afternoon, Nastasha. Thanks for having me. There's been quite a bit of a pullback across markets across the globe. Some disappointing numbers coming out of China. They are coming from their hard lockdown, not growing as much as markets were hoping for. And indeed, globally, manufacturing really lagging and really being a services-led economy. There's also been some negative sentiment in the US, where we saw better than anticipated unemployment numbers. So that's a case where good news is actually bad news. And the worry there is that, that gives the US Fed a bit more room to hike rates a bit more aggressively, as they are reaching, their peak. We also saw some credit ratings downgrades. So a bit of volatility, in markets dissecting, some of these events as they unfold. Year to date, still positive locally, still positive in the US and across the globe. So just some profit taking and some pullback from some of the rallies we've seen earlier on in the year.
So we saw MTN report their interim figures. I see the share price up 7.6%. What were the highlights from you when you look at those numbers?
Yeah, I think really positive results, double-digit growth in revenue and earnings per share. Just some upward revision and guidance for capital expenditure, but within their desired appetite for capital intensity. Also seeing, markets responding quite positively to the memorandum of agreements with MasterCard to take up a minority stake in their group fintech, which MTN values at about 5.2 billion. So the share is up on very high trading volume. So, a lot of positivity, up year to date as well. They did highlight, some macroeconomic challenges, that they navigate across their different regions. There was a bit of margin pressure on the back of weakening currencies against the dollar in their respective markets. But, overall, a positive result. Still need to navigate the macroeconomic landscape, still need to navigate, the regulatory environments across the different regions where they operate. But they did see, some strong results and subscriber growth, data usage, coming through quite positively there.
Speaking of navigating a tough operating environment, we're seeing that from Sasol, where they're expecting their basic earnings per share to be as much as 84% lower, and they talk about these operational challenges and a tough environment to blame. That share price down 4.8%. What did you make of that trading update?
So there's certainly some global factors, that are out of Sasol's control. The one thing is, their earnings are highly correlated to global oil prices and energy prices, and that coming from a super cycle. Over the last 3 years, we've seen oil prices coming down quite aggressively, so less participation there. Locally, they do have some challenges on the Transnet side, from a logistics and supply perspective, with a whole lot of backlog, within the trucking sector as well. So, the primary mode of transport that they would want for their imports and exports would be, the railway. So struggling on the Transnet side. Then they are very energy intensive as well. And so the load shedding and inefficient supply of energy in the country really negatively impacting them. Some specific write-downs in Sasol as well. looking at the Secunda refinery, negatively reviewing their production levels, input costs increasing slightly, and then their energy emissions revision targets also implying some write-offs there, so not doing as well as they would have anticipated. Some positive revisions on the Lake Charles project, but overall a very terrible result for Sasol, and it's one of the worst performers on the top 40 today.
Well, we have U.S. second quarter earnings, coming to a close. When you look back at some of the numbers that came out from some of the companies, what stood out?
Negative earnings growth on aggregate across, flat to positive sales growth, and the biggest negatives and disappointment coming in from materials and energy sector. As mentioned earlier, disappointing growth from China and lagging activity in manufacturing, and commodity prices coming down quite aggressively. Tech sector, a lot of counters did come in negative, but there were quite a lot of positive surprises and positive market reactions really across board. Expectations over the next 12 months in the US is for positive earnings growth. But that also depends, on the macro picture and what happens to interest rates and consumer spending propensities from here on.
Which is quite interesting then, because I've heard analysts who've come on the show who've talked about, U.S. stocks looking expensive. And the concern is that we could see earnings deteriorate as we start to see the Fed's interest rates work through the economy. Do you share those concerns, or are you slightly leaning to a different side?
It certainly, there is, some concerns, in our portfolios. We've taken a bit of profit from some of the strong rallies we've seen in the likes of Apple and Amazon and some of the tech counters. Long term, we still like them. We are concerned in the near term, and, just redeploying, in lower duration counters, which are a lot more profitable and a bit defensive. And if you look at the last 30 to 35 years, if history is anything to go by, when you do see this aggressive monetary policy normalization, it does tend to come with some, negative consequences in the near term. There is a lag of up to 18 months between when monetary policy is implemented and when we start seeing it in terms of the fundamental numbers and spending. One complexity in the US, is the fact that there's been quite a bit of excess savings from the COVID period, which has meant that consumers has been a lot more resilient than ordinarily would have. The elevated inflation has also created a less competitive environment where a lot of companies are able and willing to actually pass on a lot of the input costs pressures that they're feeling to consumers, and not necessarily worry about their competitors taking up their market share, with a lot of competitors following suit. So it has been a tricky one to navigate. We are slightly concerned, but long term we still like US markets.
Ricardo, thank you so much for your time. That is Ricardo Smith, who's the Chief Investment Officer at Absa Investments. We're going to take a quick break. When we come back, we'll look at earnings from Absa.